This is general information and not advice. Please speak to a licensed finance professional about your circumstances. Stanford Financial is authorised under Australian Credit Licence Number 541480. Further information is available at stanfordfinancial.au.
Hey guys, I'm Daniel Parsons here for the Ipswich Real Estate Podcast. I'm here with Steve Beach, running through what has happened in the latest RBA meeting. Want to run through a little bit what's happened with all that kind of stuff, would you?
Yeah, no worries at all. I guess what actually happened was, unfortunately, rates have gone up again. So boo on that one. So we went from 4.1 to 4.35. So it was only 0.25% rate rise. There was talk a little bit behind the scenes from a few economists that the RBA may have done a 0.5% increase like we saw when inflation sort of got a little bit rampant through COVID. But good news is it only was a 0.25% rate rise.
And in your opinion, what caused this decision?
I guess inflation data that's actually came through, and it came through about a week ago. So it was good that we kind of had a inside rail into what was actually going to happen. So inflation data actually came in a little bit lower than what everyone was forecasting. So unfortunately, it did go from 3.7% up to 4.6%. They were expecting it to be about 5% inflation. Now they do want it between 2 and 3%, so it is really high. But one interesting fact was what they call as underlying or trimmed inflation, which is basically what the RBA sort of balances on. That remained at 3.3. So it went from 3.3 last month to 3.3% this month.
Were there any kind of, in particular, standout figures that kind of stood out to you with everything?
I guess the easy one was transport, so fuel costs.
Through the roof.
Yeah, that went up to inflation, and that one was at 8.9%. So that's just unheard of. Other one was usual housing prices. So again, that takes into consideration rent and the price of, and what's probably being quite particular talking about is the price of building a house. So they actually sort of talked a little bit about two waves of inflation that we'll see due to the Middle East conflict. One is the immediate effect, which was just fuel prices went through the roof, which was crazy. The second wave of effect now comes from businesses. So because we at the petrol pump have seen higher fuel prices, now businesses are copping that in the back end with fertiliser and diesel and transport. We're now going to see that come through in retail sales. So the cost of building a house, even the cost of transporting goods. So just going to Woolies to buy a loaf of bread, all these sort of services are going to increase in price. So that's why part of the reason why they sort of lifted in I guess the cash rate for inflation, is this second wave that we're going to see that's going to come through probably over the next 3 months. With
this announcement, what kind of cause and effect has it had with like unemployment?
I guess unemployment has remained unchanged for the last couple of months. It's still at 4.3%. We're not seeing as many more jobs or more so hours worked, which is how they calculate the unemployment rate. I guess with lifting of inflation rates, people are going to have less money to spend, which, they are anticipating a higher unemployment rate to come. So that's that sort of, fine line that the RBA tries to manage is keeping inflation under control, but also keeping unemployment at a sustainable level, because we don't want really, really low unemployment, but we also don't want really, really high unemployment. Then people have no money, and then inflation then plummets like we saw.
So AI hasn't taken all of our jobs yet?
They did make a little bit of a comment about AI. It is something that's been quite topical, particularly a lot of agencies. Anything that's sort of data driven is focusing on AI. The banks we're seeing, and particularly in the IT sector, we're seeing mass redundancies or mass unemployment in that factor of the fact that these AI services, ChatGPT, Grok, Claude, which I think is the latest and greatest thing that's come out now. More companies are getting on board and utilising those systems. Even our organisation, we use a lot of AI.
Obviously, we had a bit of a discussion before we got started. You mentioned some interesting figures regarding property growth in terms of Brisbane as a whole compared to maybe other capital cities. You want to run through that as well?
I guess quite topical. A lot of conversations I'm fielding at the moment is a little bit of people sitting on their hands going, hey, I'm just waiting for the market to crash. Everyone talks about that there's a downturn in the property market. I guess for us in Ipswich / Brisbane, Brisbane just last month alone went up 1.6% in property price. And then for the quarter, it's actually currently sitting at 4.7%. So we're not seeing the slowing down of that sort of growth. Where I guess the suburbs or the cities that are your Sydney, your Melbourne, where, we just did finance for a client for a 2-bedroom apartment in Sydney for $2.2 million. Now, you can buy a lot in Brisbane for $2.2 million. So that's kind of the price point market that we're seeing, go down is your $2 million, $3 million, $4 million properties, and they're not going on the market. So that's why they're saying that there is a downturn in the property market, is these really high-end prices, or even in that high-end market is not going on the market because they're not going to get the prices that they want. The property prices that keep growing is your first home buyer market, sub $1 million, or even just creeping over that mark. Mm-hmm. Those properties are just, there's no slowing down, because the cost of actually replacing or rebuilding one of those properties, if you're going to build a brand new home, it's almost doubled in the last sort of 3 years. So,
crazy, isn't it?
So has property prices, and they just go hand in hand.
So obviously we have the budget next week. Is there any kind of insight on what's to come with that?
I guess with every good budget, they start kind of leak some information out to the public just to see what sort of reaction that they get. And if it is really bad, then they kind of pivot and change the budget. But a lot of it is being speculation. So the biggest thing that everyone's been talking about with the budget is capital gains tax. And more so directly about property, but capital gains tax affects shares and business sales and all that kind of stuff. But if we're talking about properties in itself, one thing that they have announced is, or leaked, is that they're going to do a 25% capital gains discount over the 50% that we have been seeing. So one thing that we have been talking about is what we call as grandfathering. Mm-hmm. So what they talked about was honouring the fact that people have owned investment properties already for the last, could be 6 months, could be 6 years, that as of when they make the announcement or whenever they put this policy in place, that'll be the date that they change that discount. So anybody that's got an existing investment property or a property at the moment, they will still obtain the 50% deduction. Then moving forward, so they can then have their property reevaluated, and then any gain that they receive from there will only get a 25%.
Is there any kind of rough timelines when that might be implicated or anything, or?
Generally, they announce it and it happens pretty quick. So it should pretty much, when they go, hey, this is what's going on, it's from that date. Yeah. So you might get a little bit busier with people going, hey, I need a market appraisal on my property.
So buy your properties now, investment properties this week. Well, that's a wrap. I'm Daniel Parsons from Ipswich's Real Estate Podcast. Thank you, Steve Beach, for joining us today. Obviously very insightful for everything you brought through. Be sure to like, comment, subscribe, all that kind of stuff. You know what it's like. So thank you very much. We'll see you on the next one.